Little bit about the overall cost of capital for any firm, as well as some more interesting mechanisms of calculating the beta using what is called as the fundamental method of calculating beta for a firm, right? Now, these are specific cases where calculation of beta changes a little bit, and we use another methodology to calculate it. So we will look at that as well. Now, recall that so far we have been kind of using what is called as cost of equity, and we were using cost of equity. We had learned that we can calculate that using the capital asset pricing model, CAPM. Remember the formula? Risk-free rate plus beta into RM minus RF, which is the equity risk premium. Correct? Now, that's the cost of equity, and the cash flows to the equity holders. Any cash flow to equity holders will get discounted based on that, right? So when we were saying that we're going to calculate NPV, if the cash flow is to the equity holder, then the NPV has to get discounted at cost of equity, right? But that's not necessarily true for all the firms. It is quite possible that a lot of the firms can get capital through any of the two sources, right? So capital can come either in the form of debt or in the form of equity. Now, if this comes in the form of debt, there is, let's say, something called as cost of debt, and there is something called as cost of equity. So the total cost of capital, should be, in a sense, a weighted cost of debt and equity, which is, very simply put, your cost of capital should be equal to weight of equity into cost of equity plus weight of debt into cost of debt. Correct? Now, weight of equity and weight of debt are in the proportion of equity and debt in the overall capital of the firm. So if I have to calculate weight of equity, how do I calculate that? That's equity divided by overall capital. And what is overall capital? Overall capital will be nothing but equity plus debt. So equity divided by equity plus debt is going to give me weight of equity. And what is weight of debt? That's debt divided by equity plus debt. So that's weight of debt as we get that, right? So broadly, we get the cost of capital, which is given by this. There's one small change that comes in, which is adjusting the cost of debt for the tax rate, right? Because there is a tax break that we get, so we eventually put a 1 minus t here. Now, how do we get cost of equity? Cost of equity is calculated using the CAPM, whereas the cost of debt, right? So this should be cost of equity here, can be calculated using CAPM, and cost of debt is nothing but the interest rate at which the company is getting a loan, right? That's the cost of debt for the firm. So that's going to give me the weighted average cost of capital for a particular company. Now let's evaluate the formula once again. So that's what the formula says: weighted average cost of capital, commonly referred to as WACC or WACC. WACC is something that is calculated by weight of equity. So that's equity by weight into rate of equity. Weight of debt, that's debt by value, where value is nothing but equity plus debt, into 1 minus the tax rate, right? So RE here is the cost of equity, RD here is the cost of debt. If the cost of debt is 10%, right? So if you're paying, if let's say you have an EBIT of 100 and you have interest of 10, then you have a profit before tax of approximately 90, and let's say your tax is 30%, so you pay 27 of tax, right? So if you did not have an interest, this would have been 100, this would have been 100, and tax would have been 30, right? So how much of the tax did you save? You saved 3 rupees in tax. Your interest was 10 and your tax saved 3, So your net interest becomes 7, correct? So if your cost of debt was 10%, 10% into 1 minus 30% is effectively 7%. That is what comes as the effective cost of debt. So cost of debt gets reduced or adjusted based on the tax rate that the firm has, and because of that tax rate that gets lowered. So that's the overall formula for weighted average cost of capital, right? Now the question that comes to us is when we use the equity value and when we use the debt value, do we use the values which are there on the balance sheet, right, which is commonly known as book value, or do we use the values which are there on the markets, which is known as the market value, right? Remember, book value for equity is equal to share capital plus reserves and surplus, right? That's the book value for equity. And debt is essentially debt. Market value for equity is the market capitalization, right? Now, usually, because debt does not get traded, market value of debt is the same as book value of debt. If debt gets traded, then you can find the market value of debt separately. But otherwise, for all practical purposes, market value of debt is the same as book value of debt. So let's revisit the problem. We are saying book value of debt is the same as market value of debt. Why? Is because debt usually does not trade. So if you have 400 crores of debt, that's worth 400 crores of debt, correct? But that is not true with book value of equity. Book value of equity, which is given as share capital plus reserves and surplus, may not be equal to the market value of equity. That's what the share price trades at. So now the question comes that when we are using these values of equity value of the firm or debt value of the firm, should we use book value or should we use market value? That's a question that comes. And usually the market value of the firm for equity is much greater than the book value of the firm because this is essentially what is carried on cost, right? But market value also incorporates what the company can do in the future. So that's much, much higher usually, right? Now think about it this way. If the company was going to raise money today, would they raise money on the book value or would they raise money on the market value? If the company was going to issue new shares to the market, would they go and issue that on book value or would they issue at market value? Well, the answer is market value. And so most of the times it makes sense to use the market value, right? Now, the reasons why market value is better is one, it reflects today's business environment. If the company raises equity today, it is more likely to do that at market value than at book value, right? So that's why we should use market value. Then the second point is we said market value of equity is greater than book value of equity, right? We also know that typically your cost of equity will be greater than cost of debt. Why? Is because debt is less risky. There is a priority of payment. So debt is less risky, correct? And essentially because of these reasons, if used, then equity by value goes down. Consequently, debt by value goes up because value is the sum of these two. Consequently, what it means is that overall WACC goes down because cost of debt is smaller and the weight of debt is becoming higher, right? WACC goes down, the value becomes an aggressive estimate because now you are discounting at a lower WACC than what actually should be the weighted average cost of capital as per the market scenario, right? So if the WACC should have been 13% and you get 12% by using book values, this is going to give you an aggressive estimate because you are now discounting the cash flow by 1 plus 12%. right? And cash flow in the next year by 1 plus 12% square. You should have discounted by 1 plus 13%. So if this goes down, then the overall value will go up. It might give you an NPV that is positive, where reality says that NPV should have been probably negative, right? Also, it's typically assumed that market value is more volatile and hence more prone to error. However, market value incorporates real business scenarios, right? Book value of equity will only change once annually. When you recreate the financial statement in the annual report, that's when book value is going to change. Market value changes every instant, right? So for example, if the company's MD gets arrested, right? So if the company gets involved in some sort of criminal liability, then the market value will change immediately to show that impact. So ideally, use market value whenever required. Now, this is not a concept that is immediately needed, but when we get to higher concepts around valuation of equities, that's where these concepts become important. So it's always good to remember that we should use the market values whenever we are trying to kind of use the weights of equity and debt, right? Now let's do a quick calculation. Let's assume we have to calculate for this particular company, what is the data we need? We need cost of equity, we need cost of debt, we need market value of equity, we need market value of debt, which is the same as book value of debt, and we need the tax rate, right? So we can calculate the weights correctly. So what is cost of equity? We have been given these three data points. So risk-free rate plus beta into RM minus RF, right? What is risk-free rate? That's 8%. Beta is 1.2 and RM minus RF is 7% that's given to us, right? So this will work out to cost of equity will work out to 8% is equals to 8% plus 8.4%. So that's going to give me 16.4%, correct? Similarly, cost of debt is directly given to us as 10%. Tax rate is given as 30%. What is value of equity? Remember, we don't have to use this. We have to use market value of equity. So value of equity is 15,000. Value of debt is 5,000, right? So equity divided by total value is going to be 15,000 divided by 15,000 plus 5,000. That will give me 75%. Debt by value is going to be 5,000 divided by 20,000. 20 is 15 plus 5. That will give me 25%, right? So that's weight of equity, weight of debt. Calculate WACC. So weight of equity is 75% multiplied by 16.4% plus weight of debt is 25% multiplied by 10% multiplied by 1 minus 30%, correct? So effectively the equation will rewrite itself, and I'm going to write it somewhere here, and I'm going to use another color. So this becomes 75% into 16.4% plus 25% into 7%. These combine to give me 7%. That is going to be my weighted average cost of capital. So how much would this be? This would work to be equivalent. Let's actually rewrite the entire thing. So we'll write 75% into 16.4% plus 25% into 7%. That's what we have. This will be 12.3% plus this will be 1.75%. You add them up, this gives us 14.05%. That is our weighted average cost of capital for this particular calculation. Fair enough. So that's what we get in terms of weighted average cost of capital. Remember, it's a weight that you're looking at, and you are to use market weights of equity And market value of debt is the same as book value of debt for all practical purposes. So that solves one part of our equation. We move ahead to talk about the beta question once again, which is what happens if we are calculating the beta for a firm and the firm does not have either a long enough price history of trading, or if we are not, the data is not reliable about the rise of the stock or the fall of the stock. So what happens if there is no price history? Can that happen? If a company is just listing itself, if a company is just doing what is called as an initial public offering, right? Initial public offering, then there is no price history, right? Alternatively, sometimes we might think that a very volatile stock, a very volatile stock should have a beta that should be greater than 1. If we get a beta of 0.3 on this, there is something wrong statistically speaking. So for all practical purposes, that doesn't make sense. How do we calculate beta then? It is in this case that we start using what is called as the calculation of fundamental beta. Now that's an important exercise because in reality, it is always a good idea to use a calculation of fundamental beta as well as historical beta for any firm that we are trying to value, right? We use other comparable firms. So what do? We find comparable firms in size and business and estimate the beta of these firms. This beta is done using historical prices. So you find 3 or 4 common companies and you find their beta. Then you try and find what is called as unlevered beta for each of these firms. What is unlevered beta? Unlevered beta is the beta of the firm assuming that it had 0 debt on its books, no debt on its books. So how do you do that? You take whatever beta you calculated and you divide it by 1 plus debt by equity of the firm. And because debt has a tax shield, you also do 1 minus tax here. That is what is called as unlevered beta, right? Obviously, if the firm has debt, let's take a simple case where tax is 0 and debt equity is 2. So you take the beta of the firm, which is 1.5, you divide by 1 plus 2. So that's 1.5 by 3, you get 0.5. Unlevered beta tells you that if this same firm had no debt, then their beta would not have been 1.5, their beta would instead have been 0.5. So you find the unlevered beta, find the average unlevered beta of the sector, and then you re-lever this entire data with the firm's current debt equity ratio, with the firm that is under question, that firm's debt equity ratio, right? It's a little bit complicated here. So let's try and use an example to understand this. Let's assume that we are trying to find out data for a company called RINL, Rashtriya Ispat Nigam Limited, that's planning an IPO, which is initial public offering of listing on the stock exchanges. There are 3 other steel companies that we have data for, and their respective betas have been calculated using the historical method. Their debt equities are also available, right? Now, one way is we just find out average beta of these 3. That's 1.2. If I put the average beta of RINL as 1.2, what we have basically said is that the risk of RINL is the same as risk of Steel Authority of India, right? But their debt equity ratios are not the same. Their debt equity ratios are not the same here. So logically, higher debt should mean higher risk, right? Logically, we have seen this, that higher debt, higher risk perception at least, right? So in that case, the beta should be something different. So what do? We don't calculate average here. We calculate what is called as unlevered beta first. Let's rewrite the formula for unlevered beta. So what was the formula? We take beta levered, we divide it by 1 plus debt by equity, and we multiply this with 1 minus the tax rate, right? That's the formula. I will assume a tax rate. Let's assume the tax rate to be 30%. Let's calculate it. So we are going to divide the beta, which we have found, by 1 plus the debt equity ratio multiplied by 1 minus the tax rate. Correct? That's the formula. Press enter. We get 0.68. What does this mean? Tata Steel's beta, as you calculated from stock prices, is at 1.4. But if it had zero debt, debt equity is 1.5 here. If it had zero debt, that should have been 0.68. Correct? I can freeze the tax rate in this formula and I can just drag the formula down. And we find that similar companies in the steel sector would have similar unlevered beta, assuming there is no debt. So we have basically scaled everything down for the assumption of zero debt. Now we find the average of these three unlevered betas. That should be the unlevered beta for RINL as well. So if it had zero debt, then it should have the same unlevered beta, right? Now we relever it. How do you relever it? Remember, we have found unlevered beta now. So now you multiply with the same firm's 1 plus debt by equity into 1 minus tax rate. And you should get the answer. Earlier we were dividing the levered beta to find the unlevered beta. Now we have the unlevered beta. We will multiply with this entire term to get the levered beta. Correct? So let's do that. We will take the unlevered beta and multiply with 1 plus the debt equity ratio multiplied with 1 minus the tax rate. Correct? And that comes as 1.31. Correct? Now, that's the actual correct fundamental beta that we have calculated. That's not 1.2, that's 1.31 because the debt equity is higher. And if you think about it, the debt equity of SAIL is 1 and that of Tata Steel is 1.5. This one is right in the middle approximately, right? The beta of SAIL is 1.2, Tata Steel is 1.4, so this one is almost again approximately right in the middle. So this calculation of fundamental beta allows you to identify what is going to be the correct beta for a particular firm. That's what fundamental beta does for us. That's the data we have for fundamental beta. It's considered to be a superior calculation of beta since this allows the operating characteristics of companies to come into picture. Market prices may sometimes get distorted for a particular company, but when we take the sector average, it reduces the chances of error. Market price for one firm may get distorted, but if you're taking the average of 3 firms, the chances of error are lesser. So what are the benefits? It is less error prone and it brings into calculation the key operating characteristics of the firm. More importantly, the leverage or debt that it carries. And that's why fundamental calculation of beta is an important calculation that we should kind of understand, right? That's broadly it in terms of beta calculation. Couple of questions to end this section. Explain what is the unlevered beta, how do we calculate it, and should we use book values or market values in calculating WACC? What is the simplest reasoning that comes without using any formula?